Welcome to IVoT Eye On Investing, our vehicle for discussing intelligent investing from a long-term fundamental perspective. My name is Emile Westergaard, and I am the founder of IVoT Financial Training, Inc., a company committed to providing tools and training that make financial mastery accessible to everyone. To learn more, go to ivot.academy. Today, our team, including financial advisor Ed Butowsky and market analyst Andrew Tang, discuss recent market strength as a hated V recovery, which means that a lot of institutions have missed the market run-up since April and have $5 trillion sitting in money market accounts waiting to be invested. I will then lead a second quarter review of AT&T, an incredibly cheap stock based on cash flow, and Tesla, an incredibly expensive stock based on cash flow. Let's get started.
Well, thank you very much for joining us today. And we have Andrew Tang and myself. We're going to talk about what we're saying to clients right now based on economic conditions and earnings reports that are coming out. So Andrew, why don't you take us away?
Yeah, most institutions, I would say, let me start all over. Many institutions are missing out the rally, and that's why this is dubbed one of the most hated rally. Since April's sell-off, many institutions and investors, they did not fully invest it. And that's why money market funds are sitting at all-time high right now at roughly about $7 trillion. And this is an incredible amount, and it just goes to show how much money is on the sideline still can be added to the market.
Yeah, so I'm advising clients to lock in their yields now because I believe that the interest level on interest rates are going to focus in the GDP number. And I think the GDP number is going to be weak. Forget about inflation at this point, just focusing in on the strength of the US economy. And I think we're going to see interest rates drop. And I do believe all that money in money markets going to suffer because the amount that they're getting paid is going to start to go lower as well.
Yeah, that's exactly right. Because when the front end on the curve starts to go down, and we still are on track for 2 rate cuts this year. So starting September and then sometime either in October or December, should be having another cut. And then going into next year, we expect the full interest rate to come down a full percentage point. So the money market that is slushing around at 4.5% at best right now, it's gonna have to start looking for higher yield. And remember, not too long ago, it was 5%, right? So now money market is at 4.5%. So you can see the front end reacting very, very vividly, to the interest rate movement. On the flip side of that, the back end of the curve on the 10-year yield is still hovering around, 4.5. And so that's very healthy. And so going forward with the interest rate reduction, locking in yield is a smart thing.
So, Andrew, I'm going to catch you maybe off guard here, but the 10-year Treasury is often used on the valuation of equities. How is that so? How do they value that?
Well, because when the market doesn't agree with the equity valuation or agree with the decision that are made fiscally to the economy and to our country's budget, it will start to yield higher. So meaning the bonds will also sell off in the treasury and for with higher duration, higher maturity. And it's also a reflection on inflation as well. So the 10-year yield is a reflection on confidence, inflation, decisions in the market, in the country, and it's a mixture of different signals all combined into one.
Isn't it?
Yeah, let me,
10-year
if you don't mind, if you don't mind, I'd like to pipe in on that too for a minute. Just for any investor looking at stocks, they have to compare a investment with risk to the risk-free rate. And for a long-term investor, the 10-year is a good proxy for the risk-free rate, right? So if you know, in this case, you can get roughly 4% on the 10-year, and you want to compare that to with no risk, you better be getting a premium to that if you're buying a stock. So when we value stocks on IVoT, actually, that's what we're doing. We're using the long-term discount rate, which we actually peg at 4%. We say, look, sometimes it's below, sometimes above, but on average, 4% is good proxy for the long-term corporate bond rate, as well as actually for the long-term yield on a government bond. So, so that would be cash. And then you look at saying, well, okay, if that's cash, what do I want to pay? What do I want for risk? How do I compare my asset to that? I'm not going to go into that. That gets a little technical here, but I just think in the end, what you're trying to decide is how much risk are you willing to take above the risk-free rate, and you should be getting paid for that risk.
Isn't it true that the lower the 10-year goes, the more acceptable a higher PE ratio is?
Yeah, well, that gets into the math of this. So you're discounting your future cash flows compared to the risk-free rate, right? So if you use a lower risk-free rate, then future cash flows are worth more because there's less risk. So if I know I can put my money in J&J or in the 10-year bond, and I know the 10-year bond at 4% is worth X, I compare that to J&J at 4%. I say, okay, well, let's just say, you know, let's say I'm buying $100 of the 10-year bond at 4%. And I look at J&J and I say, well, at 4%, J&J is worth 200, and I'm only paying 100 for it. Obviously, that'd be great. You know, that means I'm buying it I'm buying that risk at 100% discount. I know that's going to brain twist people if you want to think about it, but if you really want to learn how all that works, come to the IVoT platform, do our training, and this will become second nature, because what we're really talking about is the foundation of valuation and the foundation of fundamental investing.
And that's what IVoT is all about.
That's what IVoT is all about.
Andrew, let's talk about the recent EU, European Union, and the U.S. tariff discussion. And where do you think that leaves the EU? Everybody, all the countries in the EU were lambasting this president of the EU for getting such a terrible deal with the United States. With being in the United States, we're applauding it, but the Europeans are not that happy.
No, they're not, because overall there's still a 15% tariff for all goods in general coming out of the EU, and that it's going to be costly. And for that price adjustments, it means that the manufacturers or the businesses or distributors, they have to absorb that at some level, and then the prices will be tested to see if the consumers are willing to pay for it.
Yeah, and automobiles, you don't really see a lot of US automobiles in Europe, but that's going to change because the tariff has gone away.
Right, exactly. So a lot more European consumers, they will explore, US made cars, and that is a interesting sight remaining to be seen right now. The EU still have very high tariffs for Chinese autos, and that's where we see that, for example, where are the least expensive cars in the world, and that's in China right now. So the barrier for entry for Chinese good, it is still set up quite high for both EU and the US. And so the auto market it's somewhat in that phase right now.
Yeah, it's pretty exciting times, especially when you have so many people on the left uh, going after Trump for his tariff war. But in the long run, and we live on a quarter by quarter basis, but on a long run, on an annual basis, we're going to see the real benefits of this for the United States.
I have to agree because Trump is in a spot that no matter what he does, the left is going to find some criticism to it or not like it. For example, last week, the All In podcast hosted the AI Summit in DC. And from that summit, it really goes to shows that the US is serious about winning the AI war. And during the summit, you hear multiple leaders from different companies all talking about the same thing, is that they couldn't be happier that that the US government is embracing uh, uh, companies in the US and harnessing our technology, protecting it, and making sure that we are in the level playing field when compared to other countries. The obvious one that you know that is China does do a lot to subsidize and foster growth in this particular area, and giving many incentives to companies that are in this AI race. So the same that's going to be done in the US, similar to the race to space, back in the 70s, and we are entering this whole new industrial revolution, if you want to call it that way. And this is, what I dub the AI revolution in the, 2025.
Well, kind of transitioning from that into Tesla and AT&T, Emile, can you take us through the preview on the IVoT Academy training forecaster?
Yeah, sure. Actually, this week it's a review since we're going to take a look at the latest quarter's earnings season started. And as you're mentioning, AT&T reported, as did Tesla. So we're going to take a look at the updated forecaster. How did cash flow trend year over year in the most recent quarter and sequentially using the tool? I am going to show the tool here in a moment. But they are, just to contextualize this, two kind of the tale of two cities. I don't know what you want to call it. You have AT&T, which looks extremely cheap relative to its cash flow value. And I think we'd like to, I'd like to kind of put on the table, why is that? Given, it's actually, it's not really growing, but it's stable and kind of on a steady low growth rate. And then on the other side of the coin, when we'll talk about Tesla, which looks extremely expensive relative to its cash flow value. This goes back, Ed, to your question or our discussion about the 10-year rate, because in both cases, we're taking the cash flow and using a 4% discount rate to value the two companies, right? Because any company is simply a cash flow machine. That's the basic IVoT method. So let's take a look at AT&T using the forecaster for a minute here. So if I go here and I open our tool, sorry, wrong sheet. Okay, here we go. AT&T is currently trading at 27.76, and they just did a $10 billion cash flow quarter, up 4%. We'd like our companies to grow at a 10% cash flow rate. I think that's the bar that we would set for management in general. And on that basis, the shares are currently worth $128 per share. So you're basically buying this at a 362% implied return, roughly a 70% discount to cash flow value, which is pretty amazing. And you can see the cash flow value increased from a year ago. So cash flow is growing, not super high, but they increased the value of the company by $5. If that were to, and you can see cost of goods actually went up, so their gross margin declined, but they managed their operating expense as well. So their operating profit went up by 20 basis points. So AT&T looks extremely cheap on a cash flow basis. They do sit on $111 billion of net debt. So that may be what makes investors nervous about owning the stock and why it's trading at such a discount. That could be one topic we can look at. The other thing I would say, and this is almost more to just promote our platform and our tools. This is the level 2 of the tool. And you can see that AT&T is actually not one business. It's got 4 reported divisions: mobility, business wireline, consumer wireline, and Latin America. But you can see that mobility, which is basically their mobile phone business, is the dominant cash flow source for the company. So really, as an investor, as goes mobility, so goes your investment in AT&T. That's a huge cash flow value asset. And that business, again, is growing modestly, but growing. Actually, revenues were pretty strong if you go down in the tool, and then let's discuss AT&T. But if I go down here and I look at mobility, sales grew 7%, but operating margins declined somewhat. So let's stop there with AT&T, talk about it for a couple of minutes, and then we'll go on to Tesla.
It's interesting that AT&T has $111 billion of debt, but they still pay a really handsome dividend.
They do 4%, above a 4% dividend yield. So you're buying it cheap and you're getting paid to own it, which is not bad.
Yeah,
No.
with interest rate coming down, so a lot of people, I mean, a lot of companies that are generally in high debt, and so that's really in the utility space. And AT&T falls into the utility space here. It's quite attractive. Yeah.
Yeah, I mean, with pretty stable cash flow. Yeah. Yeah, go ahead.
I've been buying it since it was at 17 with a 7% dividend.
Yeah, exactly. Well, that's the thing, right? If it goes down, your dividend yield increases, which is nice. As long as you're buying on a regular basis. I guess, again, the question is what gets this thing to begin to approach, as a fundamental investor, we say over time a company will ultimately match its cash flow value. That's the fundamental thesis of a investor. And I know, Ed, sometimes you talk about growth versus value. For us, it doesn't matter, because if cash flow is growing, then we have to just be good at forecast. And we'll look at Tesla in a minute. It's not about what it's worth today. When you own a stock, you're owning the future. And so we have to forecast 3 years into the future. For AT&T, I'm assuming it continues to grow pretty slow, but pretty steady. And it'll be worth 140, 150 in 3 years. And you're paying $28 for it. That's not bad. And theoretically, the stock should at some point begin to really accelerate up towards its intrinsic value. And again, the mobility business, they have subscribers paying. The payment rate per subscriber is increasing modestly. So their monthly from their subscribers is going up, and their number of subscribers is also going up modestly. They're continuing to, take some share. They leverage obviously a large fixed cost base in terms of their equipment that they use to provide that service.
Well, why don't you take us through the complete opposite side of the spectrum, which is Tesla?
Exactly. So Tesla is, as you said, the opposite side of the spectrum. And let's just go straight to the tool and show you why. So on the other side of the coin, Tesla here's the tool, is currently trading at $320 a share. They did only $700 million in cash flow in the fiscal second quarter reported last week. That was down 76% from a year ago, so a pretty disastrous cash flow quarter. The cash flow value of the company is now $30 a share, down from 95 a year ago. So, you're paying $320 for a cash flow machine that has a $30 present value. Now, what we're talking about here is that's what it's worth now. We said for AT&T, business is pretty stable, so it looks pretty cheap. On the other hand, here, one thing we can say for sure is Tesla's not stable, and they have a lot going on that is either going to work or not work in the future. That's either going to turn this thing around or not, right? I mean, they need to sell more cars because they have a very heavy fixed infrastructure on their car manufacturing. And you can see sales were down 12% in the quarter. That's really all out of the automotive business, and we'll talk about that in a minute. And their costs, their gross profit went down by 80 basis points. So that also declined. And they also spent they completely boosted R&D. They spent an additional $500 million on R&D in the quarter. So you have to believe, and I think a lot of people obviously do, that Elon's got magic coming up his sleeve, and we can talk about it, AI, we can talk about robotaxi, whatever. And also even the mega packs, all the technology that they're spending money on that's coming in the next 3 years. Before we go, and I want Andrew to take this over because he's our AI and Tesla bull. If you look at the company again, level 2, we call this the sum of the parts. Again, Tesla's got 3 basic divisions. It's got automotive, it's got services, and it's got energy storage. And you can see energy storage actually doubled in value from a year ago on a cash flow basis. So that business is looking pretty good right now. On the other hand, the automotive business is basically kind of fell off a cliff. So you know, they need really, services is basically just servicing our installed base. That should grow pretty steady. So the question is what happens to automotive, and then how can energy continue to kind of grow at this 100% year-over-year rate? And you can go down to our tool here and actually make your own forecasts in each of these divisions. So that's the tool, that's the view, and maybe I'll pass off to Andrew for his thoughts on all of that.
Yeah, I mean, for Tesla's valuations, looking back at selling cars and revenue generation, it's not going to make sense at all because it's trading, at a very expensive valuation. At this point, it is really all about looking into the future. And I think the market agrees that the company is transitioning from an auto-only company to an AI powerhouse. If you look at the energy sector, just the revenue section from Tesla, it has grown to a $10 billion a year business just on the energy storage alone. And if we're looking at what is the size of the robotaxi or the ride-hail market, you're looking at somewhere around $500 billion. That is, that's the total addressable market. They call that TAM, right? And obviously, winner take most is not going to be winner take all situation. But among the 2 viable operators here, Waymo and Tesla robotaxi, these 2 are competing quite fiercely at the moment. Then you have to look at scalability and cost of goods sold for Waymo, for example. And this is where Tesla is largely ahead because of the high cost of setting up a unit for Waymo. The cost for bottom line, putting a unit out there is somewhere around $100,000 to $120,000. And that's insane. And that's why, again, I talked about this before, that Waymo's been operating for 16 years, and yet this, up to now, they still cannot scale. All the billions of dollars that they're losing each year are hidden in the balance sheets, and they're not even carving it out. So that's really no wonder why LiDAR, it's becoming out of favor slowly, even though many other companies still embrace it. But they are, meaning Waymo, they are testing quietly behind the scenes on how to do video AI and video intake versus the LiDAR and radar combination. That redundant system, again, it's not going to be scalable. And if you look at the cost, the existing off-the-shelf Model Y right now can be a robotaxi. So I think we all can agree that slowly but surely, autonomy is the future of transportation, or it's going to be a big part of it. And Tesla has the ability to scale at the moment. And in 2026, when we expect Cybercab, which is an even lower cost unit, to be available, you're looking at even cheaper. So right now, off-the-shelf Model Y, the cost basis is roughly about $30,000. When Cybercab comes out, which is the 2-seater with no steering wheel, the cost is somewhere around $20,000. So there's just no comparison.
Well, that's obviously, it's funny. I'd like to have a team of analysts, and that's our goal at IVoT. It's actually, as people move through our programs, they can become IVoT analysts. That's our pathway for users if they want to work with us as analysts, part-time, full-time. We're going to have those jobs available. But I think, again, doing the research on everything you're saying as the bull case, I mean, there are obviously a lot of bears. I mean, years ago when they were just launching the car and everyone, I had a lot of hedge fund buddies short Tesla. And
Mm-hmm.
again, I'm not a value investor. I'm an investor.
Mm-hmm.
And we did forecasting of their fixed cost and variable cost structure with a team of analysts I had working with me at that time. And we were like, you can't be short this thing. If these cars take off, this thing is going to be a cash machine. And 2 years ago, this thing had a cash flow value of in excess of $200. It's just this has gotten tough. It's gotten much more competitive. And also, as you're saying, they're spending a huge amount of money, $500 million of excess money on
Yeah.
R&D this quarter on all these things you're talking about, AI,
Yeah.
the mega packs, and obviously the robo-taxi. And I guess I'd like to understand and how they're actually going to monetize the robo-taxi. Meaning, are they going to try to be Uber and have a robo-taxi business? They talk about allowing their car owners to
Yeah.
actually rent out their cars during the day,
Mm-hmm.
which is kind of an interesting concept. And then how do they get paid for that? What's the revenue split with the car owner? If the car owner owns the car, are they paying a 10% commission, a 50% commission for renting out the car? I don't know.
Yeah,
You're a
that's a great
Tesla owner.
question. Yeah, that's a great question. So what Tesla is going to do is they're not going to partner up with an existing operator like Uber or Lyft or anybody else. They're going to do it themselves. The app is under development, and what's going to happen is that Tesla Robotaxi network is going to be their private proprietary network, and it's going to be available for people to participate in it at a professional level. So you can put up your robotaxi or your car to be the robotaxi in your particular area, and the riders can sign on and use the app similar to what Uber and Lyft they're all doing right now. And it's going to be revenue share. The most important thing to understand is the cost per mile, right? So cost per mile for Lyft right now is still somewhere around $1 to $2 per mile. But for Tesla, and I don't want to sound too aggressive here, but we're talking about 25 cents at the bottom line. But
Right.
even if we double that, let's say make that 50 cents or so, that is the cost per mile for operating robotaxi for Tesla, the
Right.
Tesla Robo Network. So that's why, in terms of competition, it is going to be very fierce. And that's why you also see Uber, they're just investing feverishly into multiple business venture because they know that they have to diversify and change their business model because there's going to be a new kid in town in that particular space. And it's not just taxis, it's going to be shuttles and vans and all sorts of different operators out there. And eventually, Tesla owners can put up their cars to be operating on this network. And when the Cybercab comes out, I think it's going to sell out really, really quick. And it's going to be sold to fleet operators, for example. So you could set your
But
own company and then have multiple units and work in the robotaxi network.
the big question is it going to be that much revenue to support the lofty valuation that they currently have?
Yeah, that's just one area in robotaxis. Obviously, the company has many business ventures that are going for it. AI, it's a big area. For example, the autonomous technology, it's going to be available to license to other OEM car makers, okay, and globally speaking, and not just in the US. And they have the energy business that is booming, that is growing quite well. Um, the other smaller item like carbon credit, revenue, that's really small on the side. And I'm not even talking about Optimus, the humanoid robot, what that can be. The revenue numbers, it's just going to be insane. So just robotaxis, autonomy, and all the AI tech stack that's going on for Tesla, we still believe that the stock is going to be much higher from here, let's say within 2 years.
Okay, hold on. So first of all, let me be clear, we don't recommend stocks here. So
These are not recommendations, of
and
course.
and secondly, I want to say this, I'm going to talk the IVoT game again for a minute.
Hmm.
What we're talking about in IVoT terminology is level 3 modeling, which we also support on our platform. which says, in this case, it's not enough to just look at automotive. You have to look at the underlying businesses and calculate cash flow. To Ed's point, what is the revenue model for the robotaxi? What is the cost structure? Because again, this all sounds space age cool as shit, right? But the reality is, as an investor, all it is another way to generate cash flow. And what we need to do as IVoT investors is sit, model it out, and model out the future cash flow based on each of these things that Andrew's talking about. Because Andrew can say he thinks the stock's going to go up. I have no interest, to be blunt, Andrew, in that. I don't care what you think. I want to model out the cash flow and say in 3 years, the cash flow value of this company, based on everything we're saying, will be $500 a share. Then I know we want to own it. I don't, but we have to know the details. I have to know how many units what are the units, first of all, with robotaxi. I don't even understand quite what those are. Is it per ride? Is it per day? Is it per car owner? Is it a license? I don't understand that. You're talking about the cost per mile, but does that benefit fall to the car owner, or does it fall to Tesla, and in what way to generate future cash flow? And you could say the same thing about the AI robots, the same thing about the mega packs, everything. So there's a lot of work for us to do at IVoT, and I want to come back over the next 6 months, and hopefully in 6 months we'll have all of this level 3 modeled out. I showed you level 1, level 2. We're gonna have some glorious level 3 tool that our users then can come in and play with. Again, when you come to IVoT, you'll come and you'll be able to use that tool and make your own forecasts and decide for yourself what you think Tesla's worth. Because again, what's the cash flow going to be?
Yeah, I think you're going to require a whole episode just dedicated to this area.
Oh yeah, it's going to be a fun one. I think we'll plan on that one sometime in the fall. I'll get to work on that with some of my users.
Love it.
Well, I want to thank everyone for watching IVoT Eye On Investing. Please subscribe to our YouTube channel and click on the link in the description to register for early access to the platform opening soon, which includes access to our powerful IVoT Forecaster and fundamental investment training. See you next week for our weekly fundamental update on the market and our stock of the week.
Thanks, Ed.
Thank you very much.